Hello and welcome to this conversation on BloombergQuint. An RBI-appointed committee on household finance submitted its report on Friday, giving us a sense of the landscape for household finance, which is not surprising in the trends that it outlines, perhaps more surprising in the fact that we haven't been able to alter those trends. Just to first give you one chart which summarizes what this tells us about India and compares it to other geographies. If you look at the assets of the Indian average household, a large chunk of them, the highest proportion across major geographies, continues to be in real estate. Physical assets account for 95% and only 5% is invested in financial products. That is comparable to Thailand, a little bit higher than China, but the real surprise perhaps is in the proportion of real estate holdings within that asset pool. On the liability side, the problem for India and Indian households continues to be unsecured debt, and Indians have the highest proportion of unsecured debt across these geographies as outlined in this chart. Joining us to have a conversation on this is Professor Tarun Ramadorai, Professor of Financial Economics at the Imperial College London. He was the chairman of the committee which submitted this report. Professor Ramadorai, thank you very much for joining us this morning, sir. I guess, my first question is that when you look at the findings, the numerical findings of this report, and I know that there's a lot beyond that, but one tends to shake one's head and say that, for all of these years, we've been talking about deepening financial markets, bringing products, going beyond top cities in the case of mutual funds, etc. All of that seems to have done precious little in terms of making a dent in the Indian preference for physical assets.
So I think you've identified something important. As we highlight in the report, having done a fair bit of data analysis to get to these findings, that is indeed correct. I mean, it seems like some of these preferences for physical assets have been stubbornly persistent across the years. And this has been a problem that policymakers in India have found very difficult to sort of get around. Now, I mean, I think the important question that you have to ask is, rather than thinking about this as a problem that needs to be solved, I think the report's perspective is, what features of the institutional environment are there that is making people optimize in this fashion? Yeah. Right? So, I mean, I think the question not to ask is, why are Indians being so silly about this? Because, they have, I have a huge amount of respect for the intelligence of the average Indian, including myself. And I think what we do is we optimize in response to whatever stimuli we're given by the institutional environment. So if you look at many of the problems, the physical asset issue that we identify, the lack of pensions and insurance that we identify, as well as the stubbornly high unsecured debt holdings, especially from non-institutional sources, I think what this is telling you is that the formal institutional mechanisms are not working as well as they ought to. So, for example, if you think about the problem of gold and real estate, this is a multifaceted problem. The first one, of course, part of this is that, there isn't a huge amount of tracking of either gold or real estate. And so some of this is certainly because there's a little bit of, wealth diversion towards these kinds of assets rather than to financial assets, which can be more easily tracked. So obviously then we have to create the enforcement mechanisms that allow us to have more legitimate transactions in various areas to kind of hone in on where the transactions are, where the wealth is actually being located, and then tax on that basis. So that's kind of one obvious issue. The other one is that, gold actually provides an enormous source of collateral for especially poor households. So if you think about a poor household in India that has a large stock of gold, they are able to easily go to a gold loan company in the event that they require a loan, and then within 15 minutes they can walk out with 75% of the collateral value in their hand. Whereas if you think about the fact that if they needed to get an institutional loan and actually get short-term credit from an institution, instead of going out and just pushing the gold at someone and getting the loan in response, then the process itself is enormously bureaucratic. It takes a huge amount of time. It could take up to 2 days. For a poor household, this is a huge amount of time taken away. So the question really is, how do we improve the institutional framework so that they're competing with the traditional frameworks? And I think the traditional frameworks have served people extremely well. Those systems have come up in a clearly an environment in which they were an optimal response to various institutional arrangements. But now the question is, how do we shift those institutional arrangements to make them work for the average Indian? And that's really at the heart of this report.
Professor Ramadorai, that's exactly it. So if you look at the last point that you're making, and you look at the banking system, for instance, there you could argue there is enough competition in the banking system in the scheduled commercial bank space. Then you had the small finance banks come in, you had the payment banks come in, you have the RRBs. So it's not a shortage of institutions and hence a shortage of competition which is preventing these frameworks to develop to the advantage of customers. Then what is it? Are we targeting the wrong metric? So at some point in your report, you talk about the lack of trust being a bigger factor than lack of access. Maybe that's the mindset that needs to change from a regulatory and a banking or a financial system perspective, that attack that problem and not just the access problem.
So I think you're completely correct about that. I think we sort of have this tendency to think that if we solve the hard, in other words, verifiable input problems, that everything is going to work out fine. But I don't think that's quite right, because I think you're completely correct to point out that there are a set of soft inputs as well. So for example, if I go to a restaurant, even if the building looks very nice and the rooms are fantastic and the furniture looks terrific, if the service isn't good, then I'm not going to have a good experience at the restaurant. And very similarly, if you think about the fact that when I'm going out to get a banking product, and if I'm a person of low income and I have little self-confidence in my ability to go and actually engage in the transaction, then the thing that's most important to me is that someone is there willing to hold my hand and take me through the process. And the other thing is, of course, there may be these feelings which we identify in the report of shame and embarrassment and, a whole set of issues that are associated with this lack of self-confidence that can make it extremely difficult for these poor households to actually come in and do their business in the bank, which they should absolutely have the ability to do. So now the question is, how do we actually change that? I think you're right that part of this is we've got to target these different metrics. But one of the other solutions that we propose is that perhaps we should depersonalize some of these interactions by using technology. Now, you might say, well, poor households don't have a lot of access to technology. And I don't think that's quite right, because as we know, cell phone penetration, even if it's not smartphone penetration, is enormous in our country. And people have a lot of access to technology, even today, even in very remote parts of the country. So the question is, how can we do things at a price point that's quite low, in a seamless fashion, that depersonalizes these transactions and makes them very, very normal for people, even at the bottom of the pyramid? And that's really, I think, what we should be after.
Professor Ramadorai, there was another interesting part, the link between insurance and non-institutional debt, which you bring out quite clearly. And again, intuitively, when you think about it, you say that, that's fairly obvious that if you don't have insurance in times of emergency, you'll want debt and you'll want it quickly, so you'll go to these non-institutional sources. But then again, at the regulatory level, you have not seen that coordination, for instance, between the insurance regulator, the banking regulator, to be able to tackle that problem, again, from this perspective, as opposed to just saying, let's open bank accounts. Are you pitching for sort of greater regulatory coordination then, sir, in some of these issues?
So I think you've identified one of, I think, the more important aspects of the report, which hasn't really been picked up yet. And I think you're completely correct. So from an economist perspective, once we looked at this, as you said, it seemed fairly obvious. But, most of the things that aren't very obvious seem fairly obvious once they've been pointed out. And so we were quite, interested to discover this correlation. And it seems, as you say, so as to kind of provide a little bit more background, what we're saying essentially is that if you think about the perspective of a person who is walking into any market without an insurance. So let's take a health insurance market, for example. So they don't have health insurance because for whatever reason, insurance has not been something that the culture has been there for insurance and so on and so forth. And then what happens is at some point in the future, they suffer a health emergency. Well, now the person has two options to insure. Either they actually have taken the insurance policy up front, and then when the health emergency strikes, they get a payout. Alternatively, when the health emergency strikes and they're uninsured, what tends to happen is that then they'll go out there and take short-term debt, obviously to tide them over the crisis that they've currently had. So now the question is, which one of those two alternatives is the better one? Well, clearly the big difference between actuarially fair insurance and the credit that you might take in terms of emergencies is the fact that you accrue a huge interest burden on that emergency credit later on. So in some cases, if you take the credit and then you have to be trapped in a long cycle of interest repayments, this can be very painful for poor households. And so what we're saying is, you have to connect these two issues. And I think that's what we've tried to do, is draw that connection. Now, the question is, what is the solution to that problem? And I think, again, you've identified something that is quite useful, which is, see, we have this tendency to regulate from a product-based perspective in these silos. And the product-based perspective is, look, this is short-term credit, so it shall be regulated by an institution that regulates short-term credit. This is insurance, it shall be regulated by a regulator that regulates insurance. Now, the point is that from the household's perspective, the household has a balance sheet. When it's optimizing, it doesn't think about optimizing product by product. It doesn't say, okay, I'm going to fix my short term debt situation first, then I'm going to fix my insurance situation, then I'm going to think about my savings.
Exactly.
If you do a little bit of introspection, you realize that households are thinking about all of these problems simultaneously. So what they're doing is they're saying, okay, well, do I either take insurance now or do I then take short-term credit later? And of course, all of these problems are linked and related. So we need a regulatory system that also operates in the same fashion and understands precisely that many of the functional aspects of the way that households pursue their individual financial optimization has to also then take into account the fact that the product regulatory system and the entire system has to work in such a fashion that seamlessly you're able to regulate all of these problems simultaneously. So you can't say, oh gosh, we have a short term credit problem here because there have been a set of catastrophes or health risks, without simultaneously thinking about the fact that there may have been an insurance problem upfront that actually caused that to exist in the first place. Now, one of the ways in which we suggest a bit more regulatory coordination is through this mechanism of what we propose, which is called a regulatory sandbox. And there we think that there's potential for an inter-regulatory organization to be set up that allows financial technology firms to have a integrated perspective of the regulatory view, and also for regulators to gain comfort with the sorts of technologies that are coming up that may be able to solve some of these problems. But I agree with you that old-fashioned coordination is also a good idea, and I think some of that is already happening.
Fair enough, Professor Ramadorai. I have two specific questions to two products, which one of them is getting a lot of attention right now, is your suggestion to link home loan rates to the repo rate. We know that the Reserve Bank has been grappling with this for years. We went from, PLRs to MCLRs and base rate in the middle. But you're saying that the simplest way perhaps is to have a benchmark which is standardized across institutions and then, mark it up based on tenor or, risk, etc.
So, I think that's right. Obviously, as you know, the committee is an advisory committee. We can make recommendations, as is the long-standing tradition of committees in the committee process in India. So, we can always recommend a whole bunch of things, but ultimately it is up to the institutions themselves to consider our recommendations after they've done the public consultation process and so on and so forth. But yes, in our view, if you think about it from the perspective of households, as we say in the report, what we don't want to do is to create confusion for the household. So obviously, if MCLR from institution 1 is different from MCLR from institution 2, then the household can find it quite difficult to compare the rates that they are seeing if they're quoted in terms of the individual MCLRs from these institutions. So as is done the world over in many other jurisdictions, what we're proposing is, yes, you have a standardized benchmark rate. Whether that's the repo rate or whether that's something that Financial Benchmarks Limited puts out or something along those lines, that's really up to the regulator to decide what it is. But we propose that standardization exists because then the quoting conventions are very similar. Then the customer doesn't suffer from any confusion. The search problem becomes much easier for customers. And I think the problem is that, what the report really tends to highlight, and I think this is important to recognize, is that we really want to try to make financial markets work for the ultimate consumer of those financial products, and that's really at the heart of this report. Is how can we make finance work better for households? And so that's really at the bottom of it. And also, if you think back and if you introspect a bit and you think back at the experience of the financial crisis that the world is only now recovering from, and that too, we don't know how long that recovery is going to last. But the question that we sort of were forced to face then is, why were people given mortgages that they couldn't afford? What were the problems in the underlying mortgage markets that caused this issue?
Yeah.
And so, we think that home loans are one of the most significant portions of the economy. As we also show in our report, mortgage penetration in our country is extremely low relative to real estate holdings. So, there is this 85% that we've referred to as being, the physical asset holding roughly across the wealth distribution. But if you look at the mortgage penetration rate, it's far lower, which means that the average Indian household, especially the young households, because we show that there's an upward sloping profile over the life cycle, which means that people are not taking mortgages when they're young and middle-aged in their peak earnings years and then paying them down over the course of their lifetime, which is what they should be doing if their consumption's moving. So in order to improve the mortgage market, we think a lot of these sorts of things which make the mortgage market work better for the average individual really need to be put out there. And that's really what we're saying.
Let me then, Professor Ramadorai, put the last question to you in a slightly more philosophical framework rather than product specific. A, what was the kind of response that you got during your consultations from regulators? B, is there already, say, an agency that looks at, that puts the consumer first, or do you think we need, an intra-regulatory body which is more consumer focused? And I understand that, say, merging an IRDA with a SEBI, with the banking regulator, there are far larger issues there, and that may not be the optimal solution. But do we need sort of a consumer-focused agency which is then looking across regulators, across products, and identifying these issues and attacking them, sir?
So, I think FSLRC has already specified the need for a consumer redress agency. And I thought that that was a very good idea. And I think that, that continues to be a good idea because obviously you want to have consumers have the ability to seek redress. That's not something that is in our committee because it has been proposed in committees of the past. Most notably, the FSLRC has done excellent work on that basis. Of course, there were many other illustrious predecessors to my own committee, including, of course, the Nachiket More committee, the Sumit Bose committee, the Nirmal Mohanty, the Deepak Mohanty committee, and so on and so forth. And many of these committees have done an excellent job. And I think, of course, the idea of having a consumer redress agency is very good. As far as, and in fact, one of the proposals that we make in our report, especially when it comes to products that are being sold to people in rural areas, is that we should, as you probably know, the current legal system is such that if you require redress, then every individual has got to seek redress on their own. It cannot be the case that individuals are allowed to collectively seek redress for products. And now this is a problem because if you think about the fact that maybe a product may have been missold to 20 individuals in one small part of the country, then for all of those 20 people, especially if they're low income, to have to come individually and seek redress to some big town and take out a day seems to me to be entirely inefficient. And this was one of the problems that we faced, which was, perhaps what we should do is allow them to delegate a representative so that we can have a little bit more sort of power on the consumer side of the equation rather than just the producer side of the equation. So that's clearly, in support of this improving the redress mechanism, as you point out. As far as the response from regulators has been concerned, I was absolutely delighted by my experience of working on this committee. The regulators who I interacted with on my committee were all first class. They were very thoughtful people. And the conversations that we tended to have were very positive. And I think there's a real desire to help and there's a desire to actually improve outcomes, especially on the consumer side. So I think I experienced that. I had a very positive experience with this committee. And I got the sense that there is a real desire to effect positive change.
That's lovely to hear.
So I'd like to see. Yeah, no, it is. It was really quite heartening. I'm an outsider to the system. I've worked in the area for several years on the academic side, but in order to actually, when working on this report, it was a real delight for me to be able to see that and experience it.
Hopefully it'll translate into something as well, Professor Ramadorai. Thank you so much. Appreciate this conversation and really enjoyed reading your report. That was Professor Tarun Ramadorai, the chairman of the Committee on Household Finance. Interesting takeaways. You can read more about those takeaways on BloombergQuint.com as well and listen into this conversation too. Thanks for watching.